These are a robust set of results. The group has shown great resilience in the face of exceptional conditions created by the pandemic and the rolling national lockdowns. Our revenues and profits are at encouraging levels. They were impacted by some negatives, the weakness in equity markets, lower interest rates, and an increase in the FSCS levy. But we've navigated the period really effectively. Staff have transitioned smoothly to home working, and importantly, all of our client services were maintained at normal levels. This is a testament to all of our staff. We've also continued to develop the business transformation program, and more on that later. Looking ahead, we're really well placed despite all these challenges. We're in a financially very strong position and will continue to focus on our growth initiatives. We expect to make good headway in the second half.
We started the period with our funds under management at 20.2 billion, some 16.2% lower than they were a year ago, as a consequence of the sell-off which took place between January and March with the onset of the COVID-19 crisis. So to achieve revenues for the half of 81.9 million, just 4.1% lower than a year ago, was, in my opinion, a decent result in the circumstances. This was achieved by all divisions of the group contributing their bit. First of all, the market, as represented by the WMA Private Investor Balance Index, recovered 10.2%. And our investment performance added a further 2.7% for clients. Our mix of business also improved. We had, on average, 59.5% of funds under management as managed assets during the half, by comparison to 55.4% a year ago. Markets have been more volatile and transactional volumes were some 20% higher. This particularly benefited Charles Stanley Direct, whose commission income was up 70% on the period, which in part helped offset the predicted decline in interest income arising from lower interest rates. And then financial planning continued their good period-on-period growth, up 15.4%, arising from both additional financial planners having been recruited and the generally good performance of all the financial planners in the division. By comparison to revenues, our expenses declined 1.2% to 75.2 million. This decline was in truth slightly lower than ordinarily I would have expected given the reduction in revenues. And indeed, our variable costs did fall 5.6 million or 19%. However, two expenses in particular rose. The first was the Financial Services Compensation Scheme, which increased 67% to 3.5 million, something which is clearly outside our control. And then the other increase in costs was our IT costs, which were up 1.5 million. The reason for this was that halfway during the period, we outsourced our IT infrastructure maintenance and had a degree of double running costs during the period. So we expect to see the benefits of that starting to flow through in the second half. With expenses flat, the decline in revenues pretty much fell through to the profit. And our underlying profit was down 27.5% to 6.6 million. After tax, this gives rise to an earnings per share of just over 7p, and the board has declared an interim dividend of 3p in line with the board's policy to have a 2 times covered dividend. On the transformation programme, we have spent £0.6 million in the period, taking the total expenditure to date to 4.1 million. This expenditure has so far realised annualised benefits of 1.2 million, and that figure will rise to 2.5 million by the year end. We expect to spend a further £2.6 million on the transformation programme over the next couple of years, and in totality, we remain confident that this will deliver annualised benefits of £4.5 million or more during the course of our financial year ending 31st of March 2022. Turning to the balance sheet, we finished the half with net assets of 115 million, of which cash represented 80%, or £92.1 million. This puts us in a strong position both to continue on the execution of the transformation programme and also to weather these difficult market conditions. So, in summary, against the backdrop of unprecedentedly difficult market conditions, I believe these are a good set of figures. The company remains in a very robust financial position, has been able to maintain its dividend to shareholders, and looking forward, I have every confidence that we will be able to continue to execute on the transformation programme and continue on our path of improving the profitability of Charles Stanley.
The business transformation programme was launched well over a year ago and has been focused on delivering cohesive, streamlined and simplified processes the length and breadth of the firm. We broke the programme into three components. First, the client-facing front offices. Second, the operational and support functions. And third, the provision of IT. Beginning with the front offices, that programme is now largely complete and has been handed back to the businesses themselves. We've recorded significant improvements in productivity, and we now have embedded a culture of continuous improvement. Great progress has also been made with the support functions and the operations, and particularly through the creation of a middle office, which is enabling us to deliver significant productivity improvements in the way that we support the front offices. And there's lots of potential to do more in that area. We have also made good progress in the third component, IT, where we have now largely outsourced the management of our IT infrastructure. Small elements remain to be delivered, but I'm confident that we will continue to do so and indeed remain very much on track to deliver the annualized benefits which we budgeted. Turning to the outlook for the second half, the economic prognosis, of course, is still very challenging. It will be a long time before the UK economy recovers to the levels at which it was operating prior to the pandemic. And equity market valuations right now are quite elevated against that backdrop. Of course, they've benefited from monetary policy, which has flooded the markets with newly created money. So with that backdrop, investment returns are expected to be relatively modest. But we're well positioned to deal with uncertainty thanks to our strong balance sheet. We have no debt, substantial cash balances, and a comfortable level of regulatory capital. Turning to the longer term, we're very positive. We remain focused on business improvements and growth, and there are substantial opportunities for the firm in the years ahead.